Today's episode 10, and they gave me a whiteboard. Today we're talking about taxes, which is everybody's favorite subject. Just kidding, it's only mine. Hello everyone, and welcome to the 10th episode of SWBC's Uncharted Wealth Podcast, where we break down the complex financial topics into simple and easy to understand terms. That way we can help you navigate your journey with confidence. I'll be your host, Mike Walters. I am a certified financial planner and a wealth advisor here at SWBC. And boy, today is going to be a fun one. I get to draw on a whiteboard, okay? And this is something I do all the time with clients, right? So today's going to be a fun one. And today we're talking about taxes, which is everybody's favorite subject. Just kidding, it's only mine. But not all money is taxed the same. And if you don't know the difference on how it's taxed, you could be paying extra to the IRS, whether you know it or not. I am 100% for everybody paying their fair share of taxes, but just not leaving behind a tip to the IRS. So in today's session, I'm going to walk you through one of my favorite presentations to do with clients. I'm going to break down how the IRS taxes the different types of money. There's 3 different ways: taxable, tax-deferred, and tax-free. It's a visual, straightforward way for you to understand where your money sits and how it grows. That way you can plan smarter for your financial goals. I'm going to be walking you through one of the whiteboard presentations that I do with everybody, well, just about everybody that comes into my office, whether you are a prospective client or an actual client of mine, or maybe you're just trying to get a little bit more educated on the financial topics. This presentation is something that I've done 1,000,000 times, and I plan on doing 1,000,000 times more. So we're going to dive in today with the tax diversification presentation. And you'll notice here that I'm going to draw some buckets, okay? And very first thing you'll notice is that I wasn't an art major. I mean, I did do a little bit of art in high school, but I didn't major in it, so I'm going to have to ask you guys to forgive me for not being a very good artist. There's other things that I was better at in life. But anyways, so these are the 3 buckets, and these represent the 3 different ways that your money is taxed with the IRS, okay? They are color-coded for a reason, and which I will get into, okay? So this first bucket, this is what we're going to call the taxable bucket, okay? The second one, tax-deferred. And the third, tax-free, okay? I'm going to break each one of these down for you, just so you understand all the different ins and outs of each one, okay? So now, this first one, the taxable bucket, and I'm going to zoom in here on this one. So if I draw a timeline like this is right now, and for up here, we'll just put later, okay? When money goes into this account, it is money that has already been taxed, okay? So I'm going to put a check mark here. Because right now, taxes have already been taken out. Then, as this money grows, and that can be either with interest or dividends, or if you have gains in some stock, as that money grows, the year that you get that growth, or the year that you get that interest paid out, again, you have to pay taxes on it. And you'll know if this is one of these accounts because you'll get a little love letter from the IRS starting with a 1099. That could be a 1099 div, 1099 INT for interest. If you get a 1099, you know you have a taxable account. Okay, so you paid taxes when it went in, you're paying taxes as it grows, and then later on, when you go to potentially pull money out of this account, if you have a gain, when you pull the money out, that's where you'll also pay taxes on the capital gains, okay? And notice I put later here because this taxable account is the most flexible out of all 3 accounts, okay? And that's why it's being labeled as the blue account. This is your water. It's liquid. I want you to remember that this money is the most flexible. You can put as much in here as you want. You can take as much out as you want with no restrictions, no penalties. However, there's really no tax benefits to this account. You are taxed at every step of the way, as you can see. When you put money in, it was with money that was already taxed. As it grows, you're paying taxes on the year that that growth was received. And then if you have a gain when you sell and pull the money out, you will pay a capital gains tax. Now, here's some common types of accounts that you might see that represent this taxable bucket. So your cash in the bank. If you have any type of individually registered brokerage accounts, so like a stock trading account, a lot of these accounts people were opening up with Robinhood or E-Trade that were just called investment accounts, not retirement accounts, investment accounts. That's what we call brokerage accounts. It can be in your own name, it can be a joint account, it could also be labeled as a trust. That's how these are taxed. They're all taxed this same way, okay? And I'll throw another one in there. Real estate is very similar to this. Obviously, you're not paying on any kind of income that comes into the house, like as far as interest or dividends. But let's say you sell your real estate, there will be a conversation to be had about whether you owe capital gains on the house sale or not. So, moving on. We're looking at our tax-deferred bucket. Okay, so this is the second bucket that we're going to work through. Now let's zoom in here. Now we're going to draw this same timeline. Doing like that. This is now. Now at the end of this timeline, I'm not going to put later, I'm going to put retirement. Okay? There's a good divide between the blue bucket and the other two buckets on the right, because these other two buckets are going to be some type of tax qualified account, okay? And in order for you to get any kind of benefits with these accounts, they're going to impose some type of restriction or limitation on you for using them, okay? So the first restriction there is retirement, okay? So you may already know when you put money into any type of retirement account and you try to withdraw that money, if you are under the age of 59 and a half, unless you qualify for some type of special exclusion, you will get hit with a early withdrawal penalty. Okay, that penalty, 10%. So 10% of what you withdraw is going to be imposed as a penalty tax. Okay. Now, starting with this timeline, when you put money into this account, we're going to put an X there because you are not paying any taxes up front, right? And then, as this money grows, whether it's interest, dividends, or market fluctuations, you can be buying and selling different stocks or bonds or whatever in this account. It doesn't matter what you do in this account, you're still not paying any taxes on it as long as the money stays in that account. Now, this is where it changes. When you get to that retirement age or you start taking money out of this account, that is where you have to pay taxes on it. And it gets taxed at your ordinary income rates, just like you were receiving a paycheck, okay? I like to tell clients that these pre-tax accounts, these tax-deferred accounts, I don't like to think of them as retirement investments. I like to think of them as you just pushing off your salary until a later time. Because when you start taking money out, like I said, it's going to come to you just like you're receiving a paycheck, because that's exactly how it's taxed, okay? You are just deferring your own income until later on. The only difference is that you can invest it, okay? There's one thing here that I want to mention about this account. Now, what if you get to retirement and you have enough income, whether it's Social Security, maybe you have a pension, or maybe you've done a great job saving and you have a bunch of cash sitting there and you're like, well, I don't really need to dip into my retirement accounts in order to pay my living expenses. Well, the IRS is sitting there licking their chops saying, I need to get me some of that money, right? Because you have not paid any taxes on this at all. There is a certain age where you have to start taking money out. It's called a required minimum distribution, which is RMD for short. Right now, the RMD age is age 73. Okay, so if you have any money in these tax-deferred accounts and you turn 73, starting that very next year after you turn 73, the IRS is going to force you to take money out. Okay, there's a calculation based on the account value and your age. but we're not going to get into that. But just know that you have to start taking RMDs when you turn 73. Side note, in 2030, the RMD age is being bumped up to 75. So if you're not going to be 73 before 2030, then you can pretty much assume that your RMD age will be 75. So we'll just put 73 here right now, /75. Now, what if you're like, no, this is my money. I'm not going to take it out. Well, then they're going to hit you with a penalty. Okay, right now that penalty is 25%. Another penalty because you didn't take your money out. So you can take your money out, you can not take your money out. I mean, ultimately it's up to you, but if you want to pay more taxes than you really want to, then that's where not taking your RMD is really going to bite you in the end. What type of accounts do we see these tax-deferred treatment happen to? Okay, so you might already be guessing that your 401k, your pre-tax 401k is a tax-deferred account. Your traditional IRA is a pre-tax tax-deferred account. Now there's a lot of different types of IRAs. There's SEP IRAs, there's simple IRAs, there are 403Bs, there are 457As, there are TRS for our teachers, there's TSP for our military and federal service employees. There is a lot of ways for you to save in these tax-deferred buckets. And I don't think the IRS did that unintentionally. I think they've been telling you to save, save, save for your retirement for decades, putting them into these tax-deferred buckets as an incentive to save for retirement, right? Now, the last kind of benefit that you get from these tax-deferred accounts is as long as you make under a certain amount of income in the year, when you make a contribution to these pre-taxed accounts, you can actually take an income deduction in the year that you make that contribution. For example, if you made $100,000 in 2025, and let's say you did $15,000 of contributions to your pre-tax 401k, not looking at any other credits or deductions or anything like that, then you would only show $85,000 of income for that year because that $15,000 is being treated as a deduction from your income. Okay. Side note, forgot to tell you why the tax-deferred bucket is red. It's red because I want you to think of a stop sign, okay? Anytime you are going to pull money out of a tax-deferred account, I want you to stop. That's good enough pause. Stop and think about what this is going to do to your tax situation. No matter what you do inside this account, it does not matter. But once you pull money out, it is going to affect your tax situation, okay? So that's why it's red. So we'll move on to our last bucket here, the green bucket. This is the tax-free bucket, okay? So let's draw our timeline just as we did before. We'll put now at the beginning and retirement at the end. Again, there are some tax benefits to this account, and so they are going to apply some kind of limits and restrictions in order for you to get these benefits. Right now, when money goes into these tax-free buckets, you are paying the taxes on the front end. Similar to you getting a paycheck, taxes are being taken out, and then that money hits your bank account. All the money in your bank account is usually assumed to have already paid its taxes. That money then goes into a tax-free bucket. That's how it starts. Similar to the blue bucket, okay? Taxes have been paid on the front. Then, as it grows, do you think we have to pay taxes on it? You in the back.
Nope.
You've been paying attention. Good job. No, you do not have to pay taxes on it because guess what? You paid the taxes on the front end. So the IRS is just like, okay, well, whatever. We're going to continue to let this account grow without having to, incur some taxes on it. But here we go again. Again, same 59.5 limitation there. If you pull money out before then, there is a 10% penalty for early withdrawals. But as long as you're above the age of 59.5 and you have managed to keep this account open for at least 5 years, okay, there's a 5-year rule for these accounts, you can pull out everything from this account completely tax-free. I'll say that again. You can pull everything out of this account completely tax-free, okay? What does that mean? That means if you pulled out $100,000, you will not owe 1 penny on that $100,000. That is completely tax-free money, okay? Another pro to this account, RMDs. Remember we talked about these just now with the tax-deferred. Well, do you think the IRS is going to make you start taking money out of this at some point? No, they are not. There are no RMDs with these accounts. Just like I said before, you paid the taxes on the front end. The IRS doesn't care what you do with the money after that. It's a good thing to know. So what types of accounts do we see that grow like tax-free accounts? Anything with the word Roth in front of it. So if you were thinking, oh my God, this is a Roth, then you are right. If you were here in person, maybe I'd give you a gold sticker, but you're not. Too bad, so sad. Roth 401k, Roth IRA, anything with the word Roth. And if you're actually wondering what Roth means, there is no fancy meaning for the word Roth. It's not an acronym. The senator that proposed the bill was a guy named Senator Roth.
Hi.
And he just happened to name it after himself. So there you go. There's your tidbit of useless knowledge. Well, it's not useless, but you know what I mean. Okay, so your Roth 401ks, your Roth IRAs, money's going in with already paid taxes on money, okay? And then as it grows, it's going to grow completely tax-free. When you get to retirement age and you've had those accounts open for at least 5 years, no matter what, anything you come out of that account, completely tax-free. No RMDs, you can let it grow, you can let it grow, let it grow. This is a great way to build generational wealth, okay? Because when we go back to look at these buckets, you know, from a larger view, this red bucket, this tax-deferred bucket here, if you were to pass away and you leave anything behind in these types of accounts to your children or your beneficiaries, they will inherit this. You know, guess who has to pay the taxes on that? Well, somebody got to pay the taxes on it. You died, you didn't have to pay the taxes on it, but guess what? Now your kids have to pay the taxes on it, or whoever you leave it to, right? Now, there are some exceptions. If you leave it to charity, obviously they don't have to pay taxes on it. But if you're trying to create generational wealth, this might not be the best way to do it because taxes are going to get it, okay? They're going to get it whether you pay it during your lifetime or your kids are going to get paid in their lifetime. Now, the tax-free bucket, okay, we're looking at the Roth again. Leave behind money to your heirs or your descendants, Roth. Yes, they inherit it. They still have to pull it out within a certain amount of time. But again, it's completely tax-free. They can set this money up for their kids or your grandkids or whoever. You know, that's how you're going to get these generational wealth building every generation that goes. Okay. Now, there are a few other types of accounts that grow tax-free, right? They're not necessarily retirement accounts, but I'm going to throw this in there just as some extra bits of information for you, okay? So this next one, a 529 plan, okay? This is an education account. So if you wanted to open up an education account for yourself, for your kid, for your nephew or niece, whoever, you can save money in a 529 plan and it will grow completely tax-free. And then when you go to make withdrawals from this account, as long as it goes towards qualified educational expenses, you don't have to pay any taxes on it. So it's a great way to pay for someone's higher education and with some type of tax benefit. The last one here, this is the golden one, okay? And I'm going to circle it with a different color. HSA, this is a health savings account. This is the best vehicle in the planet to save money. Why, Mike? Why is it the best? I'm going to tell you. Triple tax benefits. Okay, triple tax benefits. Well, what does that mean? Well, first of all, when you put money in this account, just like a tax-deferred account, you get to take a deduction. Okay, so you get to take a deduction in the year that you make that contribution. Similar to your 401k, you make a $10,000 contribution to your 401k, your income drops by $10,000. Same thing with the health savings account. You make a, X amount contribution in the year, it will reduce your income. It also grows tax-free. Both of these tax-deferred and tax-free accounts, while it's growing inside the account, it's growing completely tax-free. You do not have to pay any taxes on any, buying, selling, interest, dividends, anything that happens in that account, you do not have to pay taxes as it goes. And then the last tax benefit here is when you withdraw, okay? I should have said tax-free growth and tax-free withdrawals, okay? As long as when you pull the money out, just like the 529 plan, when you pull the money out and it goes to a qualified medical expense, you know, those expenses that just increases every year by like insane amounts, these are the things that you need to be thinking about long term, okay? When you pull money out of these HSAs to go for qualified medical expenses, it is completely tax-free. These HSA accounts are the only thing right now that gives you that triple tax benefit. And did you know that you can actually invest the money inside of your HSA? So here's a pro tip. If you're putting money into a health savings account, go in there and invest that money. Don't let it just sit in cash. And then to take it one step further, don't use your HSA for medical expenses. What? You just told me that was what it was for. Yes, but while you're working, while you are not in retirement age, I do not want you to spend money on medical expenses from your HSA. Now, this is not investment advice. I'm just giving you a broad statement, but think about it. You let this grow and grow and grow and grow. When you get to retirement, where healthcare starts to drop, medical expenses start to go up, you start thinking about long-term care events or having to be put into a home or something like that. That's when you're going to have the most expenses when it comes to medical, right? The two biggest expenses you're going to have in retirement, taxes and medical. So why not have an account that you can start growing today, have it grow completely tax-free, and then when you get to retirement and you have those higher medical bills, that's when you start using your HSA, okay? So just think about that. Now, these three accounts here, like I said, these are the three different ways that your money is going to get taxed with the IRS. There are pros and cons to all three of these, as you can see. But the main point of this is to diversify your holdings in retirement so that way, no matter what happens, whether tax brackets go up, tax brackets go down, whether you have charitable intentions, whether you want to leave money behind for your kids or not, having money in each one of these buckets is going to give you the most flexibility in determining how much taxes you're going to pay in retirement. And by setting this up now and getting 10, 20, 30 years of growth inside each of these is going to give you the best possibility and the best opportunity to be diversified with your taxes in retirement. And this brings us to our uncharted territory for this episode, where again, I'm going to go through some common misconceptions about tax diversification. So, first one is, most people think they need to have a magic number saved in order to retire. But most people don't realize is that where are the taxes being accounted for in that number? Right? So you hear somebody, I want to have $1 million in my 401k before I retire. Okay, that's great, but you're probably going to pay anywhere between 15 to 40% on taxes on that $1 million when you take it out. So you actually have maybe somewhere between 600,000 to 900,000, right? So that's just the misconception there. You want to have a magic number, but you're not taking into account the taxes that are going to be involved when you actually go withdraw that money. Now, we're taught to save early and often, but rarely are we taught to actually diversify our taxes in retirement, or how to build a flexible retirement income strategy as we approach those years. When we start pulling out income from different sources, how can we do it the most efficient way to try and lower our overall tax bill? And the misconception on all this is that people mostly believe their taxes are going to be lower in retirement. Now, show of hands, who has heard that before? Your taxes are going to be lower in retirement. There's a couple hands. Just kidding, there's nobody in the room with me. But, your taxes may be lower in retirement, but that is not always the case. A lot of times, and I'm speaking from experience, a lot of my clients end up actually in the same tax bracket that they were in when they were still working. Okay, you might have fewer deductions, you might have RMDs that push you into those higher tax brackets, you might even unknowingly push your Social Security benefits to get taxed at a higher level. So all things that you may not be thinking about. So again, it's not about planning to have this perfect alignment of your retirement accounts and your taxes and your benefits, so on and so forth. It is just about preparing for it thoughtfully with those consistent small wins over time. So if you're unsure about how your savings are positioned or your investments are positioned tax-wise, maybe you're leaning too heavily in the pre-tax bucket, or maybe you have a lot of taxable accounts generating dividends and interest, now's the time to start planning that, okay? Talk to your advisor, do some research, keep watching these podcasts, wink, wink, nod, nod. Ask the right questions and really take control of your financial future. Don't be a silly goose, okay? So we're wrapping things up today. I want to thank you, everybody, for a great episode, or at least I thought it was great. Thanks for sticking around. Hopefully you learned something today. As a reminder, nothing in this show is supposed to be taken as investment advice, tax advice, or legal advice. And always remember that these are opinions of myself, not the opinions of SWBC or the other people that work here. So keep listening to the podcast. You're doing great. Tell your mom, tell your dad, tell your brother, sister, grandma, everybody that you love. Tell them not to be a silly goose. We'll see you next time. Look what I did. We'll see you guys next time. Okay, ready? Let's go. And ready? Let's go. Yep. I get to draw today. You like that, didn't you?
Investing involves certain risks, including possible loss of principal. You should understand and carefully consider a strategy's objectives, risks, fees, and expenses, and other information before investing. The views expressed in this commentary are subject to change and are not intended to be a recommendation or investment advice. Such views do not take into account the individual financial circumstances or objectives of any other investor that receives them. This information should not be considered a solicitation nor a recommendation of an offer to provide any service in any jurisdiction where it would be unlawful to do so under the laws of that jurisdiction. Past performance is no guarantee of future results. Please consult with your individual tax professionals and/or attorney for additional information.